Gold is the oldest commodity and form of payment in human history. It has been used for thousands of years to create jewelry as money for exchange, and now it's even used in our modern technology in certain electronics. And many experts, including Ray Dalio, recommend that all investors should keep some gold in their portfolio. But today, there are many different ways we can invest in gold, so naturally, many investors are confused about which one they should choose. The most common question is whether we should invest in gold by buying the actual material, gold bars or coins, or by buying a stock of a gold mining company. Here are some very important aspects you need to know before you invest in either of them. You need to understand that buying physical gold and investing in a gold stock are not the same. They are very different. When you buy gold bars or coins, you are investing in a commodity. But when you buy a stock, for example, the stock of a company that mines gold, you are investing in a business. There is a huge difference. In fact, those two can have very different results. You might lose money with the physical gold, but earn money with the mining company or vice versa. The price of physical gold is determined by supply and demand. If investors think that gold will be worth more in the future, they buy more, and that demand brings up the price of gold. But gold is not a productive asset because it doesn't generate any money. On the other hand, a gold mining company is a business, and a business is a productive asset. Ideally, it generates money over time. In fact, you can even earn dividends if you invest in a gold mining company. So keep in mind, they are not the same. They are very different assets in nature. So if you want to invest in either of them, you might want to invest in them for different reasons. Personally, I don't own either of them, but if I would have to choose, I would probably prefer buying a gold mining company. Here are some of the reasons why. One of the risks with physical gold is that you never know if you are buying a real or a fake one, especially if you buy it from another investor. And fake gold bars are hard to detect if you are not an expert. The latest fake gold bars are very professionally made. Scammers usually use some cheaper metal plated with gold, and they even copy the marking on it, so people can't tell the difference unless they are experts. If you buy physical gold, you have two choices for storage. You can store it at your home, but that involves high risk. If someone breaks into your home, you can lose all of it. Of course, you can buy a safe, but buying a reliable one is not cheap. But keep in mind that most home insurance policies will not cover the loss of precious metals. Your other choice for storage is using gold storage services. For example, your local bank probably has safe deposit boxes where you can safely keep your physical gold bars. Of course, this doesn't come free. So either way, storing physical gold safely will surely cost you money. The main reason you might not want to invest in gold is that because it's not a productive asset. Gold doesn't generate anything. Therefore, gold is kind of a speculative asset. It doesn't generate money, and it doesn't pay you dividends. On the other hand, if we invest in a gold mining company, it generates money, and it might even pay dividends. For example, Barrick Gold Corporation is a mining company that produces gold and copper, and they are even a dividend-paying company. So if we would invest in this stock, as an owner we would regularly get a dividend from the company. Many investors buy gold because there is a common misbelief that gold is a good hedge against inflation. The truth is, gold was never the best option to protect our wealth from inflation. History shows that gold never performed well against inflation. The best way to protect our wealth is by buying stocks of companies that are profitable. If there is rising inflation, companies can raise their prices so they pass over the inflation to the customers. There is no better way to protect our money in case of inflation. Another reason you might not want to buy gold is that because it has bad historical returns. It's always important to check historical returns when we invest in any asset. And while past performance is never a guarantee for future results, it's always better to bet on investments that performed better in the past. Gold has a lousy track record so far, even if we compare it to bonds. Buying physical gold is completely different from investing in a stock of a gold mining company. Therefore, investors might want to buy those assets for different reasons. Investing a small portion of a portfolio in gold is not the worst financial decision an investor can make. However, we need to know the disadvantages and risks that are involved in owning physical gold.